How traders can avoid revenge trading. Revenge trading refers to the act of entering trades primarily to recover previous losses rather than to follow a predefined trading plan. The motivation behind the trade is emotional rather than analytical. The trader is no longer asking whether a setup aligns with their strategy but whether it can get the money back. This shift in mindset is subtle but extremely dangerous. In revenge trading, the market becomes personal. Losses feel unfair, and the trader feels compelled to fight back. This often results in increased trade frequency, larger position sizes, ignored stop losses, and trades taken without confirmation. The trader is no longer managing risk, they are reacting to pain. Beginner traders are especially vulnerable to revenge trading because they lack experience with losses and drawdowns. Many enter the markets with unrealistic expectations, believing consistent profits should come quickly. When losses occur, they feel shocking and unacceptable. This emotional shock triggers impulsive behavior. Another reason revenge trading is common among beginners is ego attachment. New traders often tie their self-worth to their results. Winning trades feel validating, while losing trades feel like personal failures. This emotional attachment creates urgency after a loss, pushing traders to immediately prove themselves right. Lack of structure also contributes. Without strict rules for risk management, trade limits, and cooldown periods, beginners have nothing to stop them from continuing to trade emotionally. The absence of boundaries allows emotions to dictate decisions. Just a quick reminder to please hit the like button and subscribe to the channel. Also, you can visit us on the web at investmenttees.com and use code BLOG to receive 20% off your next purchase. Revenge trading is driven by basic human psychology. The brain is wired to avoid pain and seek immediate relief. A losing trade triggers emotional discomfort, and the brain looks for a quick solution. In trading, that solution often appears to be another trade. Loss aversion plays a significant role. Humans feel losses more intensely than gains of the same size. This imbalance causes traders to overreact to losing trades, even when those losses are statistically normal. Instead of viewing losses as part of a probabilistic system, traders perceive them as threats that must be eliminated immediately. Stress hormones also impair decision-making. After a loss, the emotional brain becomes more active, while rational thinking weakens. This leads to impulsive actions, poor risk assessment, and tunnel vision, all of which fuel revenge trading behavior. Revenge trading rarely begins with extreme behavior. It often starts with small rule violations. A trader might enter a trade slightly earlier than planned or skip confirmation signals. When that trade loses, frustration increases. The trader then feels pressure to recover quickly. They may take another trade immediately, even if market conditions are not ideal. If losses continue, position size increases, stop losses widen, and discipline collapses. What began as a single emotional reaction turns into a destructive trading spiral. This escalation is what makes revenge trading so dangerous. Losses compound not because of bad market conditions but because of repeated emotional decisions. Imagine a beginner trader day trading a popular stock index using basic support and resistance levels. The trader starts the session confidently and takes a valid setup. Unexpected volatility hits the market, and the trade stops out. Although the loss is small, frustration sets in. The trader immediately looks for another opportunity, entering without full confirmation. That trade also loses. Now emotionally charged, the trader increases position size on the next trade, convinced that a bigger win will fix the situation. The market moves against them again, and a manageable loss turns into a significant drawdown. This scenario is extremely common and highlights that the initial loss was not the problem. The emotional reaction to the loss caused the damage. Revenge trading leads to overtrading, excessive risk-taking, and poor execution. Traders ignore their edge and trade lower-quality setups. Risk per trade increases at the worst possible time, during emotional instability. Beyond financial loss, revenge trading damages confidence and trust in one's strategy. Traders begin doubting systems that may actually be profitable over time. Emotional exhaustion sets in, and trading becomes stressful rather than structured. Many traders quit not because trading is impossible, but because revenge trading made it unsustainable. The foundation of avoiding revenge trading is accepting that losses are unavoidable. No strategy wins all the time. Professional traders expect losses and plan for them. They understand that success is measured over a large sample size, not individual trades. Beginner traders must shift their mindset from trying to avoid losses to managing losses. When losses are expected and controlled, they lose their emotional power. This acceptance removes the urgency that fuels revenge trading. Strict risk management is the most effective tool against revenge trading. Limiting risk per trade ensures that no single loss feels overwhelming. When losses are small and predefined, emotional reactions are reduced. Daily and weekly loss limits are equally important. When a maximum loss threshold is reached, trading stops. This rule prevents emotional spirals and protects capital. It also reinforces discipline by removing decision-making during emotionally charged moments. A clear trading plan provides structure and consistency. It defines when trades are allowed, how they are managed, and when trading stops. For beginners, this structure is essential because it reduces emotional decision-making. When a trader follows a plan, each trade becomes a business decision rather than an emotional reaction. If a setup does not meet the plan's criteria, it is simply ignored. This clarity reduces impulsive behavior and protects against revenge trading. Consider a simple trend-following swing trading strategy suitable for beginners. The trader uses the 4-hour or daily chart to identify clear trends. Trades are only taken in the direction of the dominant trend, reducing market noise and emotional stress. Before entering a trade, the trader defines entry, stop loss, and profit target. Risk is fixed at a small percentage of capital. Once the trade is placed, no adjustments are made based on emotion. If the trade results in a loss, the trader follows a mandatory cool-down period, waiting for the next candle or trading session before considering another trade. This pause allows emotions to settle and prevents impulsive decisions. Cool-down periods are one of the most powerful tools for avoiding revenge trading. They create distance between losses and new decisions. Even a short break can significantly reduce emotional intensity. Stepping away after a loss helps restore objectivity. It reinforces the idea that there will always be another opportunity and that forcing trades is unnecessary and harmful. A trading journal helps traders identify emotional patterns. Recording not just technical details but also emotional states builds awareness over time. Traders begin to recognize warning signs of revenge trading, such as impatience, frustration, or urgency. This awareness allows intervention before emotional behavior escalates. Journaling turns mistakes into learning opportunities rather than repeated failures. Risking too much per trade amplifies emotions. Smaller position sizes make losses easier to accept and reduce the urge to recover quickly. Beginners often underestimate the psychological impact of position sizing. By keeping risk small, traders protect not only their capital but also their emotional stability. Emotional control improves naturally when losses are manageable. Successful trading requires a probabilistic mindset. Each trade is just one outcome in a long series. Losses do not invalidate a strategy, and wins do not guarantee future success. When traders truly internalize this concept, they stop reacting emotionally to individual trades. Revenge trading loses its appeal because no single trade feels critical. Unrealistic expectations create pressure, and pressure fuels emotional decisions. Trading is a skill that takes time to develop. Consistency comes from discipline, not speed. Approaching trading as a long-term learning process reduces emotional strain. Beginners who focus on process rather than profits are far less likely to revenge trade. Conclusion: revenge trading is one of the most common reasons beginner traders fail. It is driven by emotional reactions to loss, ego involvement, and lack of structure. While it feels natural, it is destructive. Avoiding revenge trading requires acceptance of losses, strong risk management, structured trading plans, and emotional awareness. With discipline and patience, traders can break the revenge trading cycle and build a sustainable path toward long-term success. Thank you for watching.